Good morning, everyone, and thanks to the team at Credit Strategy for giving us the opportunity to talk to you today, but also thanks very much to you for making the time to join me. My brief for this morning was to talk to you in a little bit more detail about our understanding of how we believe open banking is helping lenders and consumers through the crisis. And to do that, I think you need to look at it from 2 points of view. Firstly, you need to understand what's happening to consumers as a result of the crisis. And secondly, you also need to understand the developments regarding the open banking ecosystem and how that's the combination of those two elements is impacting upon the way lenders are responding to the crisis and therefore helping consumers. Let's get straight into it then. So let's look at what we're seeing from the point of view of how open banking is performing. So I think there's a general consensus that the popularity of open banking continues to grow, and these stats are really meant to illustrate how it's evolved over the last 12 months. We've clearly got more API calls taking place across the ecosystem, and the majority of those calls are for what we call account aggregation, which is consumers sharing their bank transaction data to inform mobile banking apps and services such as those that AccountScore and Equifax touched on in the previous session. The success of those calls is pretty good. It's a persistent service. And also we've seen an increase in the number of regulated providers. So that's organizations that are providing services in the market out to consumers and to businesses. It's a slow but steady growth. But if you look at the stat at the bottom, at the moment, the open banking implementation entity is quoting around 2 million consumers that are using open banking. Put that in the context, though, of the total number of consumers who bank online, and that was calculated last year at about 25 million consumers. So when you look at it in the context of the total volume of people using mobile finance apps, the actual volume of consumers that have shared data through open banking is still relatively small, but it's growing, and that's quite encouraging. What are the things that we've seen happening over the last sort of 12 or 18 months? So these were some of the things that open banking set itself as a set of objectives when the initiative was first implemented in the UK, particularly on the issue of competition. So if we're being honest about it, market disruption at the moment is fairly limited. Corporates continue to partner with fintechs, and fintechs themselves are actually consolidating. So what we're seeing actually in terms of competition is a fairly limited growth in the market. And if you look at the primary objective around open banking, which was to encourage current account switching, that's not really taken off. So in some respects, it's still to fulfill its promise with regard to that particular objectives. We are seeing better products that are coming into the market, and there's some examples here. This is by no means an exhaustive list, and apologies if I've not referenced you in terms of some of the comments below, but there are new apps coming to market, and this is genuinely starting to improve customer experience. The APIs are enabling better experiences, and we're seeing that in terms of some of those apps. So if you think about the context of retail banking, we've got 6 banks that are now providing account aggregation apps in market, whereby consumers consolidate all their transaction data from all their different accounts into a single mobile app. And that's helping them to understand more about how they're spending their money. And I think the one thing that has come out of COVID that we've seen is more people actually proactively engaging with their finances. So around 20% of adults have been using online banking apps, 54% regularly. And increasingly, we're seeing consumers saying they're happier to share their data with money coaching apps. And it seems that the spare time that has been afforded us by COVID and the impact it's had on our income and expenditure has focused our attention around how we use our money, which is a really good thing, clearly. Has it resulted in better decisions? Well, I think the jury's still kind of out of this on this at the moment, and I'll touch upon this later on during the course of the presentation. We are definitely seeing areas of focus, and we touched upon it again in the last session around debt advice, supporting customers that are clearly having financial difficulties. We're seeing some good traction in the auto finance market and in mortgages, where there's an obvious application in the sharing of data automatically to support a mortgage application. And let's not forget also about the sharing of bank transaction data to support small business loans. And clearly, open banking has created some benefits to small business in terms of help to qualify the state of their finances when they're applying for support from the government. We're quite an interesting organisation in terms of the dynamics of the market. We have a direct relationship with at least 6 million consumers, and we have a trusted brand in the market. And we actually process around 60 million API calls a month through our platform. So we have a recognised and trusted brand, and we see it from both sides of the equation, from both our B2B clients, but also in terms of consumer interaction. And there's a great example in terms of the work we've been doing in the US around getting people to share their bank transaction data to enhance their credit scores. And I'll come back to that point perhaps later in the presentation. The leading use case that we're seeing in the market, and again, I think this was borne out in the previous session, is around affordability. And it's affordability across the life cycle, understanding what I earn, when I earn this, what I can spend and when I can spend. And affordability continues to be the key use case for open banking, which is very encouraging in the context of lenders across the UK. The other thing, and one of the reasons why I think this is starting to gain traction, is because of the level of insights that open banking is providing. The granularity of information that open banking provides gives you some new insight that can be used to support customers. And we can look at this in terms of customer portfolios as a whole. So understanding things like levels of income shock, how people are spending their money, whether under financial stress, that can be revealed at a portfolio level. So you start to get a measure of the overall health of your portfolio. But it can also be revealed at an individual customer level as well, so that you can start to understand the tensions that are appearing in individuals' financial behaviour, and use that to focus on creating more personalised treatments in terms of how you handle that customer. So from a consumer point of view, sharing your data has its benefits, because it could mean that actually you get more personalised and relevant treatments in relation to when you apply for a loan, or as you're managing that loan through the life of that loan, or equally when you get into financial hardship when you're in need of debt advice. What are we seeing in the market, though, in terms of the economic impact of COVID-19 and what it means for consumers and lenders? Here, if truth be told, the picture is a little bit more glum, but I think there are positives in this. So let's be honest about this. In terms of the economy, what we're forecasting is that unemployment is set to rise to around 2.7 million, and that the real unemployment rate might be currently around 5.7 million, and 5.7%, and could rise to as high as 9%. We already know that about 8.3 million Britons are overly indebted, and that the furlough has actually had a tough impact on people's overall financial stability. So around 34% of employees are currently on furlough, and 41% of them probably suffered some sort of income shock. And the issue in terms of emergency payment holidays and what it means in terms of bad debt is clearly something which is now focusing the minds of lenders in terms of how they're going to help consumers manage financial hardship. Encouragingly, though, what we've seen is that 8 million consumers have proactively sought debt advice from their bank. And it seems that they're responding to the crisis and actually reaching out. And so there's an opportunity there for banks to do more to work with consumers to help them understand how they can manage their finances better through the crisis. And open banking definitely has a part to play in terms of that conversation. At the same time, what we've also done is we've been spending time with lenders over the last few months, talking to them about their perception of the impact of COVID-19. And this has created some quite interesting insight. Origination's credit policies have been tightening. We've been seeing that. And around 62% of firms have said that on the basis of what's now happening in the market, they're restricting some of the supply of credit into the market. But note that around 38% are still saying that they're effectively open for business. 98% of you are saying that you are concerned about the impact of emergency payment holidays on credit data and people's scores. And 83% of you also say that there's a strong focus now around managing customer vulnerability, and you need to focus your attention around that. 79% of you expect credit apps to be back to pre-COVID levels, but not for another 12 or possibly 18 months, even 2 years. and that 61% of you expect that more than 20% of emergency payment accounts will not resume normal payments. So there's clearly some tensions and stresses in the ecosystem around the lending environment that is focusing people's minds about how you engage with customers. And open banking has a part to play here in terms of supporting that engagement that you have with consumers. It's not all doom and gloom though, because the other thing that we've done through analysis of our bureau data, we have realised that there's a cohort of consumers that are more resilient than others. I draw your attention to segment A here in this bubble chart, and this is based upon analysis of our Consumer Information and Credit Bureau, looking at things like consumer indebtedness, emergency payment holidays, credit scores, and so forth. And we start to tease out different segments of consumers, and we can identify how those different segments have been affected by the COVID crisis. And clearly, some have been affected more strongly than others. But there is a cohort of customers that actually still have pretty good credit risk terms, have not taken a payment holiday, they have equity in their property, they have no income shock, and they're relatively stable in terms of their jobs. So I wanted to offset some of the pessimism around the impacts of COVID-19 and the economic downturn by also mentioning the fact that there are still consumers out there that are clearly capable of affording credit and have an appetite to consume credit and can do so with fairly limited risk. Could you move my slide forward, please? Thank you. The right combination of data to inform affordability across the life cycle is clearly now more important than ever before, based upon what we're seeing in terms of the availability of credit in the market, how consumers have been impacted on that availability of credit in the market and the impact of COVID on their finances, and the data that's now available in the market. And there is a mix of data, and I think this is one of the things that also tends to be forgotten as part of the open banking debate. Open banking has a part to play in terms of assessing individuals' affordability, but it's not the only data source that's available. And indeed, there are other data sources which in some respects offer just, if not the same level of insight, but do so with a lower level of friction in the customer experience. And I think this is really important to bear in mind. Let's take the example of bureau data and what we've been trying to do at Experian with lenders over the last 12 or 18 months. And let's bear in mind that we've been involved in open banking since its inception. So we've seen the market evolve in terms of its response to open banking. And we've looked at how lenders have been choosing to deploy the information revealed by open banking versus existing bureau data. And this could be fundamentally the combination of credit information, but also summarized current account data that is shared with us on a monthly basis. And what we've seen is that lenders have been looking to blend this information into the lending experience and the lending journey. One of the criticisms that was leveled at bureau data in the early days of the crisis is that many fintechs were suggesting that the information supplied into credit bureau would not be timely enough to give the level of insight that's needed to respond effectively to a change in a consumer's income and expenditure. That's not been the case. Many lenders who share data with us have stepped up to the plate and are actually sharing information with us, updated information on a monthly basis. So we can start to monitor changes through the Bureau on individuals' income. So in particular around things like income shock, the implementation of an emergency payment, and these are now being captured by the Bureau. And the reason why this becomes important is it provides clearly timely insight that you can start to understand the impact of changes in the customer's financial position based upon the impact of the crisis. What has come to the fore, though, is the relevance, and I think Emma touched upon this in her previous session, the relevance of automated categorization of bank transaction data. And that was effectively always built and has been built as the kind of secret sauce of open banking. It was one of the elements that we felt would greatly enhance the lending experience, but also enable consumers to share greater insight on their income and expenditure data, and then to inform the lending decision about access to products and services on the back of it. And categorization is certainly starting to come to the fore now in terms of what we're seeing in the market. But it's quite interesting in terms of how it's being deployed. So at one level, you can obviously deploy real-time categorization in an open banking journey, and you can identify the vagaries of my income, my essential spend, my basic quality of living, my committed expenditure, and so forth. You can do all of that in real time, and you can then inform the decision as part of that. But that inherently involves some level of friction, because you've got to get overt consumer consent to share that data. What we've also seen happening in the market is the big banks that have large volumes of current account data and large numbers of current account customers have been deploying automated categorization engines in-house to look at how they categorize that volume of data they have on their existing customers to start informing and providing insight around that behavior. And that's just as timely as what you're seeing in the bureau data, but it provides an additional level of granularity. So there are two ways in which we're now seeing categorization being deployed. One, in batch, by banks that have large volumes of current account customers to start generating insight on the back of that analysis, but also in real time for those people that don't have access to large volumes of current account data through an open banking journey where the consumer is consenting to share that data in real time. The reason why this has become valuable and why bank transaction data comes to the fore is it starts to identify some key metrics which in the context of the COVID crisis have become quite significant. So things like liquidity, so improving and declining affordability, or it could also include recent borrowing such as payday loans. Income, and in particular things like sources of income. So if you're employed in the gig economy where you have multiple sources of income, which may be fluctuating on a month-by-month basis, that's quite important to understand. If you're employed in industry or by an employer that's been suffered increased exposure from the crisis, loss of income, erratic or seasonal income. Also, we can start teasing out elements such as bank characteristics, so a dependence on your overdraft, and also things about your behavior. So it could also identify other areas of vulnerability beyond financial hardship, which could be around a long-term commitment to healthcare spend or a dependency on benefits and so forth. So this is where open banking has really been coming to the fore, because it's been illustrating some of the more detailed attributes of consumer behavior and financial hardship, and also vulnerability, which is clearly of significance to all of you in terms of helping support customers. When we've done some analysis of bank transactional data, there's some quite interesting attributes that come out of it. So there's a couple of examples here. This is that we've done with banks over the last sort of 6 months. And you can see the level of exposure which the analysis of categorized bank transaction data provides in terms of things like income shock. And these are on quite large samples of customer data. So you can start to see what sort of information and insight it supplies. So we can start to understand immediately who's vulnerable. We can start to use that information to proactively contact the most vulnerable and mitigate the risk of delinquency. We can confirm affordability, obviously, and their continued ability to repay their loan. And we can also use this to inform portfolio health, which overall could be used to amend policy rules and your credit decisioning. So it's quite interesting about the added value that bank transaction data provides as part of this. But what we're seeing then is a balance between the use of bureau data and open banking. And people are analysing this data on either a monthly basis, 3 months or 6 months. So there's a variety of options and flexibility in terms of the way you can process this data, either in batch or in real time. But what we're seeing is a combination of bureau and open banking data. The question is, though, how's it being deployed? Well, it's this balance between automation and risk confidence. So at one level, bureau data is very simple to deploy because it's already plumbed into many lending systems. It doesn't require overt consumer consent to share data, and it can be delivered quite simply and quickly, and it can inform that decision very quickly. Of course, it doesn't give the same level of granularity as bank transaction data, and so there's an argument to suggest that where it's relevant, if you need that level of granularity, that you deploy the use of open banking to get that confidence around an individual's affordability. So it's this balance between automation and risk confidence and level of risk that you need to understand in relation to consumer circumstances that we're still seeing lenders contend with. That gets played out in relation to the sort of profile of customers you're seeing. So what this chart is meant to really illustrate is that for those consumers that present a lower risk to you, then the role of bureau data is highly relevant and very pertinent, because it's relatively low friction to actually implement, and therefore it can be deployed quite quickly. But at a higher level, where you've got greater risk and there's more need to have more granular information, that's where open banking data really comes to the fore, and that's how we're seeing it being deployed by lenders throughout the lending journey. So to illustrate that in the context of a customer journey, there will be a combination of bureau data. It could be account turnover information that is sourced from the bureau that is deployed. But increasingly, we're also getting instances whereby banks that have got large volumes of current account data are looking to analyze that data and create transaction insights that they can deploy into that real-time decision for a customer. If need be, though, and if the level of risk that you're seeing in the journey requires it, many people are now starting to deploy open banking, clearly, to then access that information at a more detailed level to understand customers. And we've touched upon some of the instances where that becomes relevant in terms of affordability pre-forbearance, and in terms of debt management and debt advice and so forth as well. But it could also be used to actually increase a credit limit or reduce a credit limit as part of managing the loan during the life of that loan. So how's it being deployed? So a couple of examples at the end here, just to touch upon in terms of what we've seen happening in the market. So this is an example, I mentioned it earlier on in terms of the deployment across automotive lending. There's a history there whereby consumers in some instances have had to share their data, bank transaction information, to actually inform the lending decision. And that's quite a wieldy and frictionful experience for a customer. So why not use open banking to do it in real time? And we've been doing work with one particular car retailer that's enabled that to happen whilst the customer is in the dealership. They can share their bank statement data automatically, and they can use that to inform the customer's ability to actually afford the loan on the car. And you can see what it's meant to the customer in terms of more instant decisions, and also the increase in terms of accepts as part of that. And they're getting greater reassurance from the data on the level of credit risk that the customer exposed to them. And that delivers a great outcome for both consumers, but also for the lender in this instance as well. Another example that we've done is in debt management, in particular debt repayment. So the use of data shared in real time through open banking to inform my income and expenditure and my continued ability to repay a loan, or in some instances, and in this instance, to pay off a debt. The issue there has always been about the level of interaction between the lender and the consumer in terms of collecting information about their income and expenditure. And open banking's enabled that exchange to take place automatically, as opposed to a consumer having to volunteer over the phone to a call handler. And you can see the impact that's had in terms of the reduction in time taken to collect that data. What was a conversation that may take 30 or 40 minutes with a call handler, in which you've got to reveal your income and expenditure data to them and other information on the phone, can now be automated and conducted in less than 2 minutes. It's always been a bit of a sensitive issue about the volume of consumers that would share data who are in debt. And clearly this is an important issue, but actually what we're starting to see is an increase. It's not as popular, obviously, as showing data in an originations exercise. But in this instance, this lender was delighted to be able to get that volume of customers automatically showing data because of the reduction in time it saved them in terms of collecting data and the number of agent hours that was involved in that exercise. Finally, the most obvious use case, which has been touched upon, is mortgages, where you have a history of showing data such as bank statements, albeit in PDF or printed fashion, with a mortgage provider to get access to your mortgage. This continues to gain traction in the market. And it's an example whereby we've been delivering this to market, creating value for the lender in terms of reductions in time taken to share that data. And what they've been encouraged by is the volume of consumers that are willing to share data in a mortgage application, which is really a testimony to the value exchange that takes place in the mortgage experience, whereby you've got to share the data. You know that by sharing data quickly and easily, actually you'll get access to your loan quicker and confirmation access to loan quicker. And it's also more secure. So there's a definite win-win situation here that we're seeing in relation to consumers sharing their data in a mortgage application, and the amount of time and effort it saves the lender in terms of sourcing that information and getting access to accurate information to inform the affordability check for that particular item. The final one I just want to refer to, which I touched upon earlier in the session, is what we're now doing around the use of data to boost credit scores. This is a case study that we originally rolled out in the US market using bank transaction data and automated categorization to enhance a credit score of an individual that might have a poor credit score. That poor credit score could be predicated simply on the fact that they're not very good at managing their credit data, their credit file. But actually, when you looked at their bank transaction data and the current account information, they have a healthy balance which says that actually could afford the loan. And therefore, we take that information and we boost their credit score. And by doing so, that enables them to get access to better products and services. In the US, we've now got several million consumers using this service to actually support their access to better financial products and services. And that's proving quite effective. And it's a great example of the way credit information can be combined with open banking data to boost and create a better outcome for a customer in the market. What does all of this mean then, by way of conclusion? And I think, what does it hold for, what's the future hold for you as a lender? So I think what we're recognizing is there's going to be increased economic uncertainty, and that's going to persist, certainly. There are going to be obviously job losses and reduced furlough supports. There is going to be increased delinquency, admittedly. But there is real opportunity here to deploy open banking to help consumers that are in financial hardship. And we're seeing that in terms of some of the work we're doing now in terms of supporting lenders, understanding kind of forbearance and so forth. But equally, those are in debt advice. But there is still a cohort of consumers out there that actually are fairly resilient and therefore could be offered credit. And the role of bureau and open banking in that instance clearly has a part to play. I'd like to stop there and thank you for making the time once again to listen to me today. And I'll hand back to Tanya for any questions, please. Thank you very much.
Rob, thank you very much. Yes, I do have a very pressing question, and that is, what is the profile of customers who are taking this up fastest? What are the richest markets in that sense?
So, sorry, just to clarify that, Tanya, do you mean the profile of people who are sharing?
Yes, exactly.
An open banking journey?
Yes, badly expressed. Sorry, yes.
Yeah, it's a good question, because the obvious response that we get sometimes from lenders is that it's needy customers. And our experience shows that it's not that. It's actually quite a different cross-section of customers. Some people are clearly in financial hardship and they're willing to share data, particularly in a debt situation, to help them get better financial advice. But we've had instances, and I gave the example in terms of that luxury car manufacturer, where it's more affluent people that are potentially actually financially secure, and they're quite willing to share their data if the value of exchange is very clear. And in that instance, where they're looking to purchase a car, they can see the benefits of it by showing data now. It means they can get approved for the loan quickly. Then they're prepared to share data. So it's not necessarily the needy. It's a mix of individuals, and it all depends upon the value exchange and the use case under which they're being asked to share their data.
And Rob, as you know, we get questions coming in all the time from the audience. And one of them is, what changes are you expecting in the open banking ecosystem? That's quite a broad question, isn't it? But I wondered if for example, in the next 6 months to a year, what key changes? Just, it's a good point to finish at, I think.
Yeah, I think it is. I mean, there is more data coming down the line. So we're already getting access to credit information for categorizing credit card transaction data and augmenting that with bank transaction data. The big thing will clearly be payments. So open banking, the next item on the agenda will be payments and automating payment initiation through open banking. The reason why that's important is it's likely to increase consumer interaction and transaction with open banking. And therefore, I think you'll start to see a jump when payments really takes off. and people start to use open banking based apps to make payments on their mobile phone or through a third party. So I think that's quite interesting as well in terms of how the payments and automation of payments will impact on consumer behaviour.
Rob Haslingden, thank you very much indeed for joining us. It is shortly time to break for lunch, but over lunch, obviously, we don't want you to be thinking about nothing, so we want to give you a poll. And the poll is this: what is the biggest challenge you would like to overcome with open banking? So please deliver your answers to that poll. What is the biggest challenge you would like to overcome with open banking? We also have a session with Western Union on the international payment landscape. Please do join us again at 12:45. I look forward to seeing you. Thank you very much.